I've got two questions. I have my window open too, so I guess that's
okay.
One is on exchanges, real estate exchanges.
Yes, sir.
What is the there's some kind of a time limit for designation of the other property, but do you have to pick the property before the exchange is documented or not?
Yes, sir. You're asking about a 1031 tax deferred exchange.
1031 tax deferred exchange, right?
Yes, sir. The timelines on that are really straight ahead, in that you need to designate the property that you would be purchasing. So when you sell a property, from that sales date, you have 45 days to designate. Now,
right. Oh, okay, but you don't have. Okay, go ahead. I'm sorry.
And of that, you can designate up to 3 properties during that time. So
that's within 45 days after, not before.
That's right. Yeah, what you're talking about there is a reverse exchange, and I would certainly recommend that you talk to the professionals about that. I think that there is some ability to do that, but that's even more specific than the IRC code.
I really want it to be after.
Okay.
I don't understand how, if you don't even know if you're going to sell your property, how do you designate? So,
well, that's exactly right. So in theory, the way that it would go is that you would you actually go into contract, so you're going to get a few days between the time that you go into contract and it closes to be able to go out and shop a little bit. But from the day that it closes, you're given 45 days to designate potential properties.
It closes. Okay, good.
And then you can have up to 3 properties, so you could research more than one. So if one doesn't work out, you didn't give up your designation. And then you need to
do that within 6 months or something like that, right?
That's right, 180 days from that, or 6 months. You need to actually close the transaction. It needs to be of equal or greater value, the sales price, than the property that you sold.
To be totally tax free. If it's less, you pay the tax on whatever the difference is. But I understand
of what's exposed, and I think that you used a word there that's a very common word to use. You kind of dance around it a little bit in semantics, but it's a tax deferred exchange. It's not a tax free exchange.
Oh, I'm sorry.
So no, which is fine, but it means that it doesn't mean that tax is waived. It just means that it's deferred for a later date.
I understand that absolutely. But the other question I have,
yes, sir,
is the under federal tax code anyway. It's any income, any gain is based on or is taxed on a capital gains rate, which is now 25%. Is that the idea?
Well, I believe that it's actually a little bit lower now. I think it's 15 right now, but they're talking about bumping it up.
So it's not 25 yet. They'd have to, the Congress would have to pass a statute or an act, wouldn't they?
Well, there's some discussion about that long-term gain tax being bumped up. It's anywhere, I've heard the figure anywhere from 25 to 35%. There's just been discussion. There would be some discussion on that, but yes, that affects a number of things. That affects real estate. That affects stock portfolios.
Sure.
It affects a number of long-term properties, which, that's kind of the one thing, from a real estate perspective, that's the one thing that sort of displaced the heirs of a farm or a ranch. Let's say mom and dad had a big farm and a ranch, and it was worth a couple $1 million. Well, then all of a sudden, when it changes hands to the heirs, the taxable event is incurred, and they want to have, now 15%, but if that gets moved up to 25 or 30%, well, 30% of a couple $1 million is a big ticket, and that forces the family then to sell the property. They were not able to keep it.
Or at least some of it anyway, yeah.
Yeah, so it's one of those things that I'm certain that, the other people that are affected by that too, which is they don't really get much attention, are those people that have their retirement accounts. So,
right.
You're retired, you take your money out, that's what a traditional IRA does, is that you pay taxes when you take the money out. So if that tax rate is increased, that means that some of our retired people that are living on fixed income at that point in time would actually be paying a higher tax rate on the money that they took out. Now, again, I am not a tax professional.
I understand.
I would encourage you to call a tax professional.
Roger that. Thanks a lot, Fred.
Well, thank you so much for the call in today. Really appreciate it.
Sure. Bye-bye.